So the big news in investment world this week is Warren Buffett retiring. What do you think? Did you think he was ever going to retire, or did you think he'd die with his hand still on the buy button?
90 something years young, at a certain point, I can say when I saw the video clip, I thought, wow, he looks tired. He definitely looks tired. Yeah. His voice was quite sort of haggard. It seemed a little bit belabored and he's tired. He lost his best buddy, he's kind of up there doing it alone. So I get it. It's interesting. So right after that, the Wall Street Journal started running all of the typical articles, praise of Warren Buffett. It was actually quite interesting, them going back and saying, here's the first time that we ever mentioned Warren Buffett. I think it was like back in the 70s. And it was about like a dispute over their textile manufacturer, Berkshire Hathaway. And they're saying the CEO of Berkshire Hathaway, which is the former guy, who resigned. And obviously the guy that pushed him out was Warren Buffett. And, they kept talking about the number of mentions of Buffett and how the sort of fame and legend grew very slowly. And then it was kind of in the 80s and 90s, by the mid 90s, early 90s, there were the mentions this guy started becoming more and more of a household name. But I don't think Buffett really became truly a household name until, late 90s, early 2000s, and then beyond, at which point he was already like in his 70s. And that's really kind of the great mark of it. One of the articles that I was reading about it was saying why there will never be another Warren Buffett. And it was, a lot of the typical things, saying he has a memory like a mousetrap. He never forgets anything. He's like an elephant and has the love of the game and was devouring the stuff when he was a little kid and all that stuff. But one of the things that I think is very interesting about him, and my old buddy Tim Price told me this one time. He said, I can't think of a person that's been that successful that basically just consistently would spell it out and say, this is how I did it. And the steps that he took to become enormously successful are easy to understand. It doesn't take a super genius. Anybody can do it, and it's just somebody who just consistently said, here's the way I become super duper successful. I follow these rules and I just happen to live for a really, really long time. Right. Which frankly, I'm like, science should study that, because this is a guy that's in his 90s who still, despite appearing somewhat haggard and tired, is obviously still with it, mentally extremely with it, physically, he's still shuffling around at least. And yet this guy drinks like cherry Coke every day and like eats at Dairy Queen. And that's like, that should be studied really. Like, how does he manage to do that? I don't know. I'm 46 and I don't do that.
Do you think there's something to do with the timing of when he was born and when he lived through? Not to take away from, obviously he's a very intelligent person, but he also did kind of live through this 1950s.
Sorry, are we talking about his health, or are we talking about his wealth?
Oh, I meant the wealth part of it. Where
okay.
He kind of lived through the boom, and he's the guy that says never bet against America. And it's like, well, yes,
you would say that if you were right, if you were born in that and you came up in that era, of course. There was we talked about this before. Like my grandfather, who was born in the 19 teens and came up during the Great Depression. This is a guy who watched banks fail, during the Great Depression, watch his close friends get wiped out, farms repossessed, all this stuff. So my grandfather would have thought you had to be a crazy person to put your money in a bank, to borrow money, and to invest in the stock market. He thought those were the three craziest things you could ever do with your money: put your money in a bank, borrow money, and invest in the stock market. I sometimes I think about what would my grandfather think of crypto, and all of that. But then you get, it's just, these things do change generationally, right? And then Warren Buffett would have been born a generation later. Buffett would have came of age at a time where America had just become the dominant superpower. Bretton Woods was signed, the Suez Crisis that kind of once and for all formally took Britain off the world stage as a global leader. This is when Buffett came of age, where it was the USA number one and no one else in sight. And this guy got to enjoy decades and decades. He was really in his 80s before the cracks in America started to show. So in that respect also, I think he had the luxury of having, that super era of the United States as the undisputed global superpower. And I think people today, they're coming into a different era where you look around and you go, well, you got $36 trillion in debt. You've got a multi-trillion-dollar annual budget deficit that Congress is doing absolutely nothing about, has seemingly no care in the world. Oh, it's another multi-trillion-dollar budget. Doesn't care. They don't give a shit about the budget deficit. It's insane. You got Elon Musk, who's like kind of single-handedly spending his time and money trying to dismantle the deficit. And he's getting fought in courts. He's getting fought by Congress. You got members of Congress that literally go and physically try to barge into the Department of Education, all this stuff. It's just, it's ridiculous. That's how little people in Washington, D.C. actually want to cut the budget. They just don't want to cut the deficit. And so this is not something that Warren Buffett really ever had to contend with until he was far, far in the twilight of his career. And it's just different circumstances.
It too, because he also said in his last letter that these are some of the things that the United States government has to do in order to allow the type of success that he's had, where you have to get the budget deficit under control. You have to have sound currency and sound money. And to his credit as well, he also tended to consolidate during these cycles, right? He saw a lot of things coming, and he built up the cash when there weren't very many opportunities out there to deploy that capital in places where he thought it was going to grow.
One of the best quotes, a very famous quote from Buffett, he said, "You want to be greedy when others are fearful, and fearful when others are greedy." I might have that reverse. I might have said fearful and greedy, then fearful. But the point is, he understood the cyclicality of things. That you've got, everything goes through cycles. The economy goes through cycles. You have a boom part of the cycle and a bust part of the cycle. You've got it's that way in financial markets. It's that way with a lot of specific asset classes, commodities, oil, goes through these cycles constantly. And Buffett understood big macro cyclicality. When he said, you want to be fearful when others are greedy, and greedy when others are fearful, he was essentially saying all these things move in cycles. Financial markets move in cycles, economies move in cycles. And you got to understand the cyclicality. And what you don't want to do, you don't want to be an idiot at the top end of the cycle and everything's great and you're making money hand over fist. You don't want to be an idiot and go, oh, well, let me go and spend. Let me go into debt. Let me go and buy things at all-time record highs. Because invariably, as night turns into day and summer turns into fall and fall turns into winter, eventually it's going to shift and you're going to be in the down part of the cycle and you're going to be caught with your pants down, right? And this is the thing that he did very well with Berkshire, is that when times were good, he built up these massive cash positions. I remember in 2008, they'd spent years during that, 2005, 2006, 2007, the boom years where asset prices are going through the roof. And he was using that opportunity to build up a huge stockpile of cash. Then what happened? 2008, the global financial crisis, stock markets tank, of all these companies that are going out of business. And one of the marquee investment banks in the world, Goldman Sachs, went to Warren Buffett with its hat in hand and said, "We need money. Please give us money." He goes, "Yeah, sure. I'll give you some money." And he gouged them on the deal. Man, did he gouge them on the deal. And it's like, yeah, hell yeah, dude. Because these are the guys that were responsible for so much of the carnage. And these guys almost went out of business. And Buffett he just turned the screws and he stuck it to these guys. And he got a hell of a deal because he had the cash to do so. And he wrote about this. And it's funny because he kind of wrote in his letter, he's like, "I've been saying this for years. I've been saying this, that we want to build up this cash position so that we have the cash that we can deploy very rapidly, that we can be greedy when others are fearful and deploy this cash very rapidly in these tremendous abundance of opportunities when the time comes." And, when you look at it, really, what's been Berkshire doing? What have they been doing for the past couple of years? They've been selling overpriced tech stocks. They've been, getting kind of cashed up, and they have this massive stockpile of cash right now. And I don't think that's an accident, and I think they've probably been looking at things cyclically and saying, maybe it's time for the cycle to turn. I think they've also been looking at, again, most of his letters have always been never bet against America, USA #1. And he's been saying that for 50 years. And now all of a sudden, this very past letter a couple of months ago that came out, we wrote about this and said, wow, this is a stark change in his tone, where all of a sudden now Warren Buffett is saying, hey, there's some problems here, guys. And, kind of wagging his finger at Congress saying, you got to fix this. You owe people a sound money. You owe people sound currency. You owe people, a budget deficit that doesn't go through the roof every single year that makes people go, oh my God, you owe this stuff to people. You owe people a budget without having to threaten a government shutdown and the debt ceiling fiasco and all this stuff. And it was the first time he's really ever said that. And I remember thinking then and there, it's like, wow, that's he's finally getting sort of realistic about that. And I wouldn't be surprised if that meant that this was his last year. And sure enough, now he's stepped down. But this is a guy that understood the cyclical nature of economies, of financial markets, and of specific asset classes. Understood that very well. He's written about it constantly, and I think that's really one of the most important things that any individual can really understand is the cyclicality. And yet people that understand that tend to do very well, and people that don't understand that tend to get caught with their pants down.
Is it easy to see where you are in any given cycle? I mean, is it
No.
obvious?
No, it never is. And in the case of Buffett, the old saying is like, nobody ever rings a bell at the top. When the stock market hits its peak, nobody shows up to the floor and says, ding, 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 this is the top, everybody. Nobody's gonna send you a text message and say this is the top. And so you have to be prepared to be early. And the reality is it's better to be early than be late. But there's always opportunity costs, and this is the difficulty, right? Is that there's things we talk about this, like I was looking at things, some years back, thinking like, oh man, this has got to be the top. This is crazy, and it wasn't the top, and it just kept going higher and higher and higher. And when you're too early on things, there's opportunity costs because you can miss out on things going ever so higher. And we talked about this in a previous podcast. It's like just because things are expensive doesn't mean they can't get more expensive. Just because things are priced irrationally doesn't mean they can't become priced even more irrationally. So it is a little bit of a difficult balance. And a guy like Buffett, who was managing hundreds of billions of dollars, you can't afford to be late because he would write about this. He said it can take us years sometimes to get in and out of a position. So if they think that like, hey, this might be the top, if they think we're even anywhere near the top, boy, we got to start selling now, right? Because it might take them 18 months to just exit their position because they're just so big, and it takes a long time to do that. Individual investors can be a lot more nimble, can be a lot more faster, but it's still important to understand the cyclicality of these things. That really is important.
There's a few things too that seem like they're at the bottom of a cycle right now. We've talked about platinum a little bit in the past, and right now it's a third or less of the price of gold. And in the past, it's been twice as much per ounce of platinum as gold.
That's why your credit card, the fancy credit card, is always the platinum card.
Right.
It's like there's the whatever card, the silver status, the airline miles, right? Is the silver status, the gold status, and then the platinum status. The platinum is always the highest, but it's got to be. Peter and I were talking about this at one point. Peter's like, hey, everybody's going to have to redo all their credit card programs now because the gold is like far and away the highest. Platinum is a fraction of the price of gold now, and that's not the way it has been traditionally.
Same thing with uranium too. I mean, it's looking like there's deficits in uranium, right? Because there's been so many years where they were able to pull it out of stockpiles, and now the mining doesn't appear to be keeping up with current demand, let alone this growing demand where not the United States so much, but other countries bringing all this nuclear power online as well.
So just to make that point, sometimes you're right. Sometimes it's a little bit easier to spot the bottom in certain commodities because you can see structural deficits in place. You can see, you go, oh, wow, there's literally not enough uranium being mined right now to keep up with current demand today from nuclear power plants around the world. There's not enough supply. There's not enough new production from uranium mines to keep up with demand. So what happens? Well, they're just drawing down stockpiles of existing uranium, and at a certain point, those stockpiles basically get to zero. And then what are you going to do? Right? I mean, it's just the laws of supply and demand are just going to bid the price of uranium up through the roof. And the reality is it takes years to bring more mining supply online. Depending on the country, people got to do environmental permits and all the geological surveys and all those things. They got to get investment capital, bring on pools of investment capital behind that. That stuff can take a really, really long time to bring new supply on. And in the meantime, anybody that's already in that business is just making money hand over fist. So sometimes with certain assets and asset classes, it's a little bit easier to see a bottom. It's a lot harder to do that in stocks. Because some of those obvious signals, again, something like, wow, this is irrationally cheap, and it can stay cheap. Where we try and see is like something, what we focus on is where something's irrationally cheap, but there's a catalyst. And if you can see the catalyst, and there's a time frame on the catalyst where you go, okay, this is cheap, and here's something that's actually going to, whether for this individual business or for this sector as a whole, is going to drive the price higher. And if you can find something that's irrationally cheap and there's a catalyst associated with it, that's the sort of thing that we think you can focus on. What I used to do personally in the past is I would focus on ratios, and I would say, oh, this is expensive because of this ratio. The cyclically adjusted price earnings ratio is too high. And what I learned over time is that who cares? It doesn't matter. It's like the silver to gold ratio. It's like people say, oh, that's supposed to be trading at 50 to 1. 50 ounces of silver per every ounce of gold. And now it's totally out of whack. It's kind of in the 80s, 90s, clearing 100 now. Whatever. I mean, it's just so far out of whack. And the reality is oh, I'm sorry. Did somebody pass a law? Is there some executive order out there that says that silver and gold have to be? No, there's not. It could go to 1,000. There's nothing that says it can't be. It could be literally 100,000 to 1. So ratios are kind of an indicator, but they're not a hard rule of anything. Right. And so what we tend to focus on is let's find stuff that's irrationally cheap where there's a catalyst in place, as opposed to just focusing on any individual sort of benchmark ratio. And I think that's where we are right now with a number of things. We talked about that there's some catalysts, sometimes an entire industry and asset class.
Well, I was going to ask you, I think a few weeks ago on this podcast, you mentioned oil being extremely cheap right now. It's at $60 a barrel, and we've seen it as high as it's gone up to. Sorry,
it's sub 60, yeah, less than $60
sub 60,
a barrel.
yeah. Mm-hmm. But in the past, it's been as high as 110, 120 even, or it's gotten up to.
Well, in the past, it's been I think record high price like $147 a barrel.
Okay.
Right. So I mean, it's in our lifetime, in a span of let's say 15 years, we saw oil peak at basically $147 a barrel to like minus $40
during the pandemic. You're talking about
right. When it's a certain point you got to look and go, who wants to be in that business? Like, that's insane. Like, who's I mean, you really have to talk about being a crazy person. You got to be a crazy person when most people, like, if I'm selling pens for a living, like, I at least have a pretty good idea of like what I'm going to be able to sell this pen for. If you're in the oil business, you have no idea. And there's that's true for like some commodities, right? I mean, if you're in, I don't know, like whatever. I mean, even the gold business, whatever. I mean, you don't really know exactly what your price is going to be, but man, that kind of range that can fluctuate so wildly. And it's like news comes out tomorrow morning, said Saudi Arabia is doing this, or there's some rebel group in Nigeria is doing that. And it just swoons all over the place. You've got to take that white knuckled ride and just have giant brass balls in order to be able to stomach that. To be in that business, it's a tough business. It's a really, really tough business. But at the end of the day,
I was just going to ask why is it so cheap right now? Are people using less oil? Are they just pulling so much oil out of the ground that it's down to these levels? It doesn't really seem like a rational response.
Most financial markets are not rational. Yeah, most financial markets are not rational, and so a lot of this is a reaction to an expectation. You got to remember, in any sizable financial market, any sizable market, where you talk about some securities being traded or assets being traded, stocks, big commodities like oil, even could be coffee, natural gas, these sorts of things. You got to remember, man, how much algorithmic trading is taking place, AI, bots, high frequency traders where there's no human being involved. And it's literally just all these guys have their little programs and applications. News comes in, AI parses it. It goes, oh, I'm going to do this. And there's no human being making any decision. And it's all going into these machine learning things. So so there is not really any rhyme or reason, any really specific rationality behind it. But in theory, the big idea here is that people go, oh, tariffs are bad for the global economy. Ipso facto, there's going to be a recession. Recession means less demand for energy. Therefore, oil should be cheaper. And so investors in financial markets go and they start selling oil contracts. They might be shorting oil. They might be doing all sorts of things that causes those oil contracts to fall in value. So oil prices fall, and they've gotten sort of lower and lower. I mean, they were reasonably high not that long ago. I mean, they've come off a lot over the last couple of months. And you get to a point now where oil's got like oil at less than $60 having a $50 something handle on it. And I think we were talking about this saying, drill baby drill at 50 some odd $60 oil, it just ain't going to happen, man. There is no drill baby drill at $60 oil, especially among the US shale producers. And we have to stop for a minute and go back and understand shale and sort of the history of that and the importance of that. Before shale, you had just conventional oil, you had the onshore oil and the offshore oil. I mean, the old school, the Texas wildcat, guys throw their cowboy hat in the air. They say, well, that's where the oil's going to be. And they go and they drill and they have those, in California as well, all that kind of stuff. That's sort of almost like a romantic view of history back to the early 20th century when we think about these old, oil wells. And then they started drilling. They found these massive oil basins offshore. And, they started drilling a lot. And then it was in the early 2000s, the early part of this century, that there was a real change. And they realized that there was just not only an enormous amount of oil from the shales, but also that they had the technology to go out and get it. And that technology got better and better and better until in a very short period of time, honestly, just a handful of years, the United States, through the shale fields, managed to bring on, in terms of both oil and gas, because remember, you can't neglect natural gas here. So oil and natural gas to combine, is both forms of energy. So the amount of energy that the U.S. was able to bring on in terms of annual production was literally like multiples the size of what Saudi Arabia was producing. So you talk about bringing on like multiple Saudi Arabia's worth of energy in a couple of years. And did that piss off the Saudis? Oh man, did that piss off the Saudis? Because they go, wait a minute, this is our thing. We're supposed to dominate that. And then practically overnight, you had these guys, these up and coming, because it wasn't ExxonMobil and it wasn't Chevron, it wasn't these massive oil companies. It was like these little guys that like nobody had ever heard of, that managed to scrape together the money and go out and do these things that everybody's like, nah, you're never going to be able to do that. And they did the things that entrepreneurs do. They do the things people go, that's impossible. You're never going to be able to do that. The big companies laughed at it. They said, no, you're never going to be able to do that. And they went out and did it. And they completely transformed the entire global energy sector. And it became a massive thorn in the side of the Saudis, of OPEC in general, because all of a sudden they're like, we could produce oil too, man. Now, the difference is that the shales, in order for the shales to be economically feasible, right, in order for these guys to turn a profit, the price of oil had to be high enough because it's more expensive and all. And over time, sure, that technology got better. It got more efficient. They got all this horizontal drilling, all this crazy technology that they're able to do that made it so much cheaper for them. But it's still expensive. It's still expensive.
So the reason they were drilling in the first place was because they could make money drilling. So they saw the price of oil at this height.
That's the cyclicality.
Okay.
The cyclicality in oil is that there's an old saying, they say the cure for high prices is high prices and the cure for low prices is low prices. And what that means is, if you think about oil, when the price of oil goes through the roof, the price of oil is $147 a barrel, what happens? Invariably, everybody starts getting into the oil business. Everybody wants to invest in oil. People want to start oil companies. And if you're an oil company entrepreneur and you stand up and say, hey, I'm going to start an oil company, then investors start throwing money at you. And it becomes, it's like, man, you could be a total screw up. And if oil is $147 a barrel, man, you're still going to make money. You could be the worst screw up in the sector and you're still going to make money. You can go out and get bank loans. And it becomes so easy that now all of a sudden everybody's throwing money at this sector. Everybody's expanding. And so what happens? All this new production comes online because all of a sudden there's all these new guys in the oil business. And there's all this new supply. Now all of a sudden supply goes up, 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 up. Demand is kind of flat, maybe even starts to stagnate a little bit. And what happens? Now supply outpaces demand, prices fall. And it works the same thing at the bottom of that cycle. Now all of a sudden oil is so cheap. Oil is minus $40 a barrel. Who wants to be in that industry? Right? So people literally they fire all their crews, they shut down their wells. Nobody wants to produce anything. Now all of a sudden there's no production, there's no new supply, but demand starts going up, and now all of a sudden it's totally reversed. You have increasing demand, supply is flat, the price starts going up, 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 higher and higher and higher. And so the market essentially self-regulates that. That's the cyclicality of things that's important to understand. That's the cyclicality in the oil market, but it works the same way in the, even in like in a big, economies are cyclical. There's literally the thing called the business cycle, that goes, and you have sort of the good periods and the bad periods, feast and famine. It's important to understand that stuff. It's important to understand those things as an investor. It's important to understand those things just in general, that, good times invariably turn to bad times invariably turn to good. And it's important to understand that stuff, because that's really understanding that there's a lot of opportunity in that.
But right now, nobody wants to drill because it's $60 or less per barrel.
It's interesting. That's not that nobody wants to drill right now. It's that for the shale, because remember, like, you have to look at the shale oil is different than conventional oil, right? So the guys doing conventional onshore oil and even offshore oil, that's different. And so the big majors, Exxon Mobil and Shell and even BP, I kind of have to roll my eyes a little bit, because some of these guys are like a lot of those guys became super woke over the last 10 years. They got infected by the Greta Thunberg virus. And you had these guys at these major oil companies stand up and say, we want to end oil. We want to stop oil now. And you go, dude, you're the CEO of an oil company. What are you? Do you hear these words coming out of your mouth? This is insane.
My favorite one was when BP was asking people to pledge what they're going to do for the environment. And somebody goes, I pledge not to spill millions of barrels of oil into the Gulf of Mexico.
Yeah, exactly. Exactly. I mean, it's obviously it's clearly, it's all talk. It's all talk. And so as soon as that tide kind of turned, all of a sudden these guys are like, yeah, we're back in the oil business, baby. I mean, there's a few of them I still kind of scratch my head, but for a while, those big oil companies were just completely uninvestable, because they weren't even, it's like, what business are you even in, man? Like, you're like an oil company, but you're all about wind power and all this stuff now. Like, I just don't get it. So now most of these guys are back in the oil business, and they're fine with $60 oil. In fact, Exxon and Chevron and these guys, they actually committed to increasing production, right? OPEC, which is sort of the ultimate, Saudi Arabia, the ultimate sort of old school cigar smoking, mustache twirling oil guy, is saying, we're going to increase production. And I think the reason it's become pretty clear they're doing it is because the shale guys are on the ropes now. The shale guys were they were the young, hungry entrepreneurs that came in the early 2000s. They came in 20 years ago saying, we're going to disrupt this market. And they did. And again, they were the guys that all of a sudden started producing, brought in all this oil. And the Saudis got super jealous. Saudis got really ticked off about that. And now the Saudis are like, it's payback time, baby. So the Saudis are like, yeah, oil's already down, and we're gonna increase production just so we can drive the oil price down even more, just to jab it in your rib cage just a little bit more, just to screw the shale guys, because the shale guys are going, man, we can't afford to produce at $60 oil. We need to have oil. There's a great commentary by the founder and CEO of Diamondback Energy, who's basically saying the shale guys, you got to have sustainably $65, $70 oil just to make it economically viable for the shale producers to be out there drilling and producing, and especially to be exploring. And we're just not at that level right now. It needs to be at least that level for an extended period of time in order to entice the shale guys. So the Saudis are sort of looking at this going, now's our chance to drive the knife in and twist it into the shale producers, the same shale producers that, took away all this market share from Saudi Arabia 20 years ago, 15 years ago. Now, all of a sudden, the Saudis have the ability to drive that knife into the shale producers and think okay, we're gonna behead these guys once and for all. And the
idea is to drive them out of business, the shale producers out of business, and then in the future, when there's less oil being brought out of the ground, then Saudi Arabia can go back and reap the rewards of a higher oil price.
Well, the Saudis are an interesting kind of place. I lived there actually back in my Army days. It's a strange and wondrous place for sure. And kind of place where when I was there, I was in the Army, and people used to do their promotion ceremonies at the place called Chop Chop Square, where they would take all the thieves and stuff like that. They would go and publicly, they would publicly behead people and chop their limbs off and stuff like that. It's a wacky place for sure. And this is a place that was just dominant in the energy sector for so long. They lost a lot of that luster. And they started doing things, if you're Saudi Arabia and you're worried that, hey, maybe our oil is actually running out, guys, and maybe we need to do something about it. Maybe we need to start diversifying our economy. What would you do? Well, the first thing you would do is you would take your state-owned oil company and you would take it public. Right? You would try and dupe investors into saying, oh yeah, our state-owned oil company is worth so much, and we're going to sell a little portion of it, just to try and raise money, just to be like, let's see what we can get for our state-owned oil company. And they raked in a lot of money for that Saudi Aramco IPO. The other thing you would do is you would take that money and you would envision some crazy, futuristic, massive construction project to try and bring in people and businesses and talented managers. Basically, they're trying to just conjure a new Dubai out of thin air. They looked at Dubai and they said, wow, those guys in a relatively short period of time became this like massive regional business hub that basically became their economic mainstay. So let's do the same thing. Let's go and take all this money and create this city out of nowhere, just create a city out of the desert, and they call it Neom. And Neom is this just like absurd. They have this like mile wide building and all this. It's like crazy stuff when you look at the plans, and they're massively behind. They're massively over budget. They had to scale back all this ambition because now they start to realize that most of the stuff is literally impossible with today's technology. But all these things they're trying to do to essentially create a version of Dubai and Saudi Arabia, because why would they do that? If they're so confident in their oil reserves, why would they do that? They would just focus on oil. They're obviously not confident in their oil reserves, which hence why they've sold off a chunk of their state-owned oil company, and they're trying to diversify and create this new financial technology service business hub out of nowhere, because they're so desperate to try and diversify their economy. The Saudis are also in big trouble. They just actually, I think today or yesterday, posted their latest quarterly numbers, and they have this massive budget deficit because their oil revenues aren't enough. So this is one of the reasons why they're trying to increase production. They're also trying to stick it to the shale producers because they know that shale producers can't produce profitably at this level. And so they're trying to basically kick these guys while they're down. Some of that's out of spite, and some of it's out of the long-term thinking of, if we can keep the shale guys down, then maybe they'll never come back. I was going to say, one of the things that's really important to understand about shale oil in the United States is that for the most part, the shale fields are really past their peak. A lot of the shale producers are really past their peak because, again, there's a finite amount of that stuff in the ground. You're talking about these hydrocarbons. Some tree fell 100 million years ago and all this sort of stuff. And it creates certain resources and so forth in the ground. And once you mine it, once you drill it, once you pump it, once you, whatever it is that you're doing with whatever resource, could be gold, could be oil, could be gas, whatever, there's a finite amount of that stuff in the Earth's crust. And once you pull it out of the ground, that's it. Right. And so these oil companies, man, they're drilling, they're pumping this stuff out of the ground. And, at first it's great. It's just, they're pulling so much of this oil or whatever resource it is they're mining or drilling out of the ground. After a while, they've sort of reached the peak of that, that particular resource, and they'll continue mining or drilling or pumping or whatever it is they're doing. Most likely not necessarily till the bitter end, but they'll keep doing it, but they get less and less and less return for that. They get less and less of that coming out of the ground. And this is very well documented. This isn't some wild conspiracy theory. The shale CEOs themselves are saying this. Actually, the guy who's the founder and CEO of Diamondback Energy, which is a Permian Basin pure play opportunity, he's basically saying that like they're facing, he calls them, geological headwinds. This is a very clear nod to the fact that most of the shale producers are sort of in decline in terms of what their growth is able to produce. And in many respects, a lot of the wells, a lot of the resources that they have are starting to be in decline. At least they've peaked, and they're on the other side of that curve now. So this is a thing that he says, this is an issue not just for our sector. I'm just reading it off of him. Is that, this is an issue for the country. This is an issue for the country, simply because when the shale oil came online, going back 20 years now, it created this just energy bonanza in the United States, and it made energy prices much, much cheaper. Energy prices are one of the most important factors in inflation. If energy's cheap, the things that energy produces, which is everything, right? Food, manufactured goods, the automobiles that we buy, all those things. If energy is cheaper, it makes that stuff cheaper to produce, and hence that cost savings is passed on to the consumer. If energy is more expensive, it drives the price higher of virtually everything that we can think of. And now even technology, right? If energy is expensive, that means that AI becomes more expensive, and AI has the power to, make everybody more productive and all these things. Well, now AI is going to be more expensive because it relies so much on electricity. So if energy is more expensive, virtually everything becomes more expensive. And he's saying this flat out, that this is a risk to the country. He actually, one of these things he's talking about, like in the state of Texas, he said in 2024, last year, the Texas oil and gas industry sent over $27 billion in tax dollars, in tax revenue to the state government in Austin. Not federal money. This is just state money to the state of Texas. Right. And so, and $27 billion in tax revenue just from the Texas oil and gas industry in state tax revenue alone. $27 billion is more than the total tax revenue for, what he said, 34 different states. And so now that's obviously at risk because you've got shale producers in decline. The growth, obviously these guys aren't going to be out looking for oil and gas. They're not going to be, more exploration, more drilling. A lot of their wells are now in decline, and the oil price is down. So what does that do to the Texas state budget? Now you talk about, are you going to get $27 billion? Hell no, you're not going to get $27 billion this year. So that's a massive impact to the Texas state budget, right? That has an impact on the country. It has an impact, where you're eventually looking at getting higher oil prices. You might be thinking, wait a minute, I thought you talked about oil prices being down. Yeah, they're down right now. And this is one of the things that we're talking about, where nobody rings a bell at the top, nobody rings a bell at the bottom. But you can start looking and seeing some of the structural issues in the industry, and you have to start wondering about the long-term viability of, is $60, $58, $55, is this actually really viable, a viable pricing structure over the long term? And if you start to look at the supply fundamentals, it really doesn't look like that's viable over the long term, because if you see Saudi Arabia is running out, a lot of the OPEC countries are running out, a lot of the shale producers are actually past their peak right now and are starting to decline. Where's the new supply coming from? Right. And there's always going to be, somebody says, well, this new supply here, and there might be some new supply there. But man, you're talking about needing a lot of new oil. And that's just current demand. And as the global economy grows, you've got future demand that you've got to think about as well. And so all those things sort of together, if you think about structurally the supply and demand imbalances in the oil market, $58 oil starts looking very, very cheap. And I would say this, I'm just quoting here again, Diamondback Energy founder and CEO, on an inflation adjusted basis, there have only been 2 quarters since 2004 where the front month oil prices, which is essentially what the current oil price is right now, have been as cheap as they are today on an inflation adjusted basis, excluding 2020, which was obviously affected by the pandemic. So it gives you a sense of, on an inflation adjusted basis, and it's important to adjust it to inflation because obviously the cost of drilling for oil has gone up a lot. He also talks about how, crude prices, the cost for the cost for drilling has gone up significantly and all these things. So when you see drilling costs go up and you see kind of on an inflation adjusted basis, these sorts of structural issues that are in place in the sector, $58 oil, I'll reiterate what I said weeks ago. Oil looks on a long-term basis very, very cheap right now. Looks very, very cheap right now.
He also said that they're actually shutting down some of their operations. And correct. That they're, instead of exploring for new oil, they're going to be using that money to repurchase shares.
Share buybacks.
You were telling me that that's a sign that he thinks that his company is a good value right now, because he's not.
Oh, he says it straight up. He says, yeah, we feel our share price was, quote, materially below the intrinsic value of our business. So, this is the founder and CEO of Diamondback Energy saying this. You take it or leave it, but it's an interesting sign. I think those guys, they talk about this. He wrote this in his update, and he was saying, we have been very diligent over the past several years, knowing that, again, as sure enough, as day turns to night, night turns to day, this is going to be a cycle. There's going to be a downturn, and we've been preparing for that downturn. And in preparing for that downturn, we've been putting cash on the books. We've made sure that we've been generating lots and lots of positive free cash flow that we can use to, we haven't gone crazy with debt levels. As a matter of fact, we're paying down our debts right now, and we're generating enough cash that we can pay down our debts, continue to build up our cash reserves, and buy back our stock. because we feel that our stock is below its intrinsic value. And that's a smart thing to do. What you find is that usually it's the opposite. You get a lot of people that in the good part of the cycle, when prices are high and investor interest is high and everybody's throwing money at you and you're making so much money, that's when people actually tend to do stupid things. That's when they go out and they say, "Oh, we're going to go out and make acquisition. We're going to acquire this company at like some absurdly high price. We're going to pay some absurdly high record price for some company, and we're going to go and pay all these crazy bonuses. We're going to buy back our stock at an outrageously high price." All these things that people do, they go into debt, they borrow lots of money, they spend that money buying back their stock or buying other people's stock to make really expensive acquisitions, and it makes their companies worse off as a result. Then all of a sudden the tide turns, and all of a sudden they go, "Wait, oh man, we can't make money at $60 oil. We're hemorrhaging cash. Now we have like this debt that we took out that we can't pay anymore. Now we've run into a lot of problems." There's a lot of companies that do that because they don't understand the cyclicality. And companies that understand the cyclicality, they understand it. Maybe they understand it in an academic way, but they still don't. They don't act prudently. And it's companies that understand the cyclicality and they act prudently. They go, this is, again, back to Warren Buffett. This is what Berkshire did for so long, as they went and they used the good times in the economic cycle to build up a cash position, boost their profitability, and all of a sudden, when the turns come, the recessions come, the financial crisis come, they go and they deploy lots and lots of money very, very quickly, right? And it's the same thing that an oil company. These guys are saying like, "Hey, we're going to go out, we're going to make acquisitions at bargain basement prices." Because it's going to be a lot of people that are just caught with their pants down. We're going to buy great assets. We're going to buy companies. We're going to buy all sorts of things to expand our business because we have the cash to do so, because we've been prudent and we understand the nature of the cycle. In this particular, oil runs at a cycle, economies run at a cycle. And so we understand the nature of that, and we're going to take advantage of it. And that's a very, very smart thing to do.
So oil being low right now isn't Greta Thunberg's big win. This isn't oil going away, its last gasps before it is finally not needed by the world anymore.
Oil is not going away. I mean, the thing that's ultimately going to drive demand for oil lower is going to be nuclear power. I mean, it's if you think about electric vehicles, right? I mean, there's a lot of oil. Oil's used for a lot of things, right? You got heating oil, you got industrial use, plastics, all sorts of things, right? But obviously, the thing that people understand oil is jet fuel, and they understand gasoline, right? Diesel fuel and whatever else. And so that's a huge demand, a huge component of demand for oil. And if you think about, you go, okay, well, let's say we have electric vehicles, and you have, on the other hand, like, well, I have to fill up my engine with either gasoline or electrons. And which of those is going to be cheaper? Right now, gasoline's a lot cheaper. But if you get to the point where you have this really abundantly super cheap nuclear power, it's going to turn out that filling up your gas tank, you're filling up your car with electrons is much, much cheaper. People are going to switch to electric vehicles simply because it's more economically viable. Right? It's not because Greta Thunberg told them to do so. It's not because Joe Biden or Gavin Newsom told them to do so. It's because it's freaking cheaper, because electrons are a lot cheaper than little molecules of gasoline. That's what's going to drive the electric vehicle revolution. And the thing that's going to make electrons cheaper than molecules, than liters and gallons of gasoline is nuclear power. And the beauty of nuclear power is that the price of uranium can go up substantially. Right. We talked earlier about how uranium is in a structural supply deficit right now, but uranium's price can go up dramatically, and nuclear power will still be cheap. It'll still be incredibly cheap. By the way, if you look at carbon emissions and all those things, if you're intellectually honest about it, nuclear power is better than wind power. It's better than solar. It's better than so many other options and alternatives. But all that aside, it's very, very cheap. Even with very high-priced uranium, it's still the electricity that comes from it is still very, very cheap. That's what's going to drive people to switch to electric, and that's going to be a huge demand drop for oil. And that, but that's years out. I mean, if they said today, Donald Trump went out and said, we're going to have this massive nuclear power bonanza. We're going to go all in on nuclear, blah, blah, blah. We're going to have uranium mines. We're going to be looking at thorium. We're going to be looking at all sorts of other things. And we're going to go all in on this. That's still the really big benefits of that, mass adoption, all that. That's 8 to 10 years away. So oil still, and last time I checked, I didn't see Donald Trump stand up saying, yeah, we're going to go all in on nuclear. They might pay lip service to it. The energy secretary will say some things, about it. But the sort of the really all in as a country, we're going all in on this. It hasn't happened. I'd love to see it. And maybe that happens tomorrow. And in which case I'll be a very happy person. But I mean, it hasn't happened. So I think oil's got a long run. This whole like just stop oil, it ain't happening. It ain't happening. Not for a while. And in the meantime, $58 oil is cheap. There are, just in the same way that we've been saying, there's cheap gold companies. Gold's at 3,300, 3,500, 3,200, wherever you want to look at. And gold is high, and there's a lot of cheap gold miners. Oil is low right now, but we think it's going to go higher. There's a lot of cheap. There's a number of very cheap oil companies that we look at, and it's some very compelling fundamentals right now.
Thanks for the insights, James.